There are a couple ways to make a potential profit from investing. One of them is by earning income. Income investing is a strategy that focuses on buying products that make periodic payments to the investor. These payments may be used as a source of income, or they can be reinvested to help your investments grow over time. Let's get a better understanding of the types of income you may receive: interest income and dividend income. Interest income is payments received on things like deposits in a savings account, or like lending money to a company or entity when you buy a bond. Dividend income is a payment received from a company you own shares in. These payments are a way for the company to pass along profits to its shareholders. Each of these types of income is taxed differently. This is something an income investor should consider when creating their portfolio. When starting an income-generating portfolio, there are some questions you may want to think about, like, how much money do I need? How often do I need it? How long do I need this income? How much do I have to invest right now? How much risk can I tolerate? And what are the implications to my income taxes? Your answers may help you determine how you divide your investments between stocks, fixed income, and cash. Let's compare each investment type. Cash generates income through interest payments, which is typically paid monthly. Products in this category often have the lowest risk and the lowest returns, but they can be a flexible option for any investing timeframe. Fixed income products generate income through interest payments as well. This interest is typically paid twice a year for bonds and annually for guaranteed investment certificates, or GICs. The potential risk and profit for fixed income can often fall between that of stocks and cash. Also, fixed income may not be appropriate for investors with a short investing time frame due to longer maturity dates and possible lock-in periods. Stocks can generate income through dividends received from dividend-paying companies. Dividends can be paid in varying frequencies, but quarterly is the most common one. Stocks have a potential to increase or decrease in price more than fixed income. Because of this, they can offer higher potential rates of return and higher potential risk. Another way an investor can possibly minimize risk is to diversify their portfolio. Instead of buying individual companies that pay a dividend, an investor may choose to buy an ETF, exchange-traded fund, or mutual fund that holds dividend-paying companies. Preferred shares are a special type of stock and may be a popular option for income investors. This is because preferred shares have some bond-like qualities. They are issued and redeemed at a par value, they have a redemption or maturity date, and they issue fixed payments. Now that you know more about what income investing is and the products that are commonly associated with it, let's go through a fictional example of someone starting off as a new income investor. Meet Lisa. She is 64 and wants to retire next year. She recently inherited $80,000. She has an average knowledge of investing, and she also has $50,000 saved in her RSP. Lisa runs through these questions before she sets out to create her portfolio. How much money does she need, and how often does she need it? After she goes through her budget, she estimates that she needs an extra $500 a month on top of her pension. How long does she need this income? She thinks her lifestyle and budget won't change over the next 10 years. How much does she have to invest right now? She'll invest the inheritance of $80,000 plus the $50,000 in her RSP. How much risk can she tolerate? Lisa needs this income because she wants to retire, but she also wants to minimize losses to what she has now. Because of this, her risk tolerance is low. What are the implications to her income taxes? Lisa is also in a low income tax bracket. She decides that the amount of money she receives from her investments is more important than how the income is taxed. Since her risk tolerance is low, she rules out investing in stocks for dividends. She decides that she will focus on different bonds and cash products instead. This income investment strategy may be ideal for Lisa because she is looking to generate a stable stream of income to cover her expenses at retirement. And by investing in fixed income and cash products, She is trying to minimize the risk to her investment. Whether your goal is to generate a stream of periodic income or to grow your portfolio over time, choosing the right investing strategy for yourself will be dependent on your unique situation.